Welcome back to the weekly roundup. I'm Abdu-Raof. To the date, it's almost 1 year since the pandemic crisis hit South Africa, and our people and our economy and our finances have taken a beating over this last 12 months. We speak to Abdulazeez today about the current state of the economy in South Africa and what we can expect going forward. South Africa obviously has been hit very hard by the pandemic, have experienced many losses in lives, and many have been infected. To add to this, the lockdowns imposed on our people in South Africa, which was necessary but had a negative impact on our economy. To unpack all of this morning, we chat to Abdulazeez of Kagiso Asset Management to give us a synopsis of what's been happening in South Africa over the past 12 months and what we can expect going forward. Abdulazeez is the Head of Research Portfolio Manager of Kagiso Asset Management, one of the people that manages our money and makes sure that we have ample amount of savings for our retirement and for our general savings purposes. He's one of those wealth creation guys at an asset management firm in South Africa. We go straight into the interview with Abdulazeez of Kagiso Asset Management. I'm sitting here with Abdulazeez of Kagiso Asset Management. Welcome to the weekly roundup once again, Abdulazeez of Kagiso Asset Management.
Wa alaikum salam, and thank you very much, Mr. Henslow.
Okay, so to date, almost a year ago, South Africa went into a state of panic and a state of crisis with the onset of the coronavirus and the COVID-19 crisis that hit South Africa and the world as such. I'm sure the last 12 months could not have been easy for you and your team at Kagiso Asset Management, and as many investors and many investment managers are probably suffered over this period as well. Your take on the last 12 months, firstly, Abdulazeez, in a broad spectrum.
Yeah, I think in a nutshell, you just have to look at my face. I mean, I've gotten so much grey over the last 12 months. And it's really been, I think a tale of two halves, or a tale of one quarter and three other quarters, in the sense that exactly a year ago we were close to the market bottom. So from about the 19th of February until about the 19th of March last year, we saw the South African equity market declining by about 35%. And certainly in my 23 years of investment markets, I haven't seen anything like that before in terms of such a significant decline in such a short period of time. I mean, to compare that to the 2008 financial crisis, we saw a similar magnitude of decline, but that was spread out over effectively about 4 months. So to see a 35% decline in a single month effectively, as I gave those dates, I think is unprecedented. And that word unprecedented was used unprecedentedly as well in terms of the frequency that it was used. But it shows that, and I think 1 year later, I mean, to see Europe still going in lockdowns, I think Germany starting their lockdown again. I think we certainly didn't appreciate the magnitude of the pandemic and the magnitude of both the healthcare crisis that unfolded subsequently, but also the devastating initial impacts on markets, and then also the swiftness of the recovery. Before I get to the recovery, I think just to summarize what we saw is, as you rightly said, I mean, this thing spread quite significantly with many countries going into lockdown, South Africa similarly, and that spooked investors. And initially we saw across the board both the mining companies, the industrial companies and the banks coming under significant pressure. So there was indiscriminate selling and it was panic selling effectively. In particular, we saw the past winners, especially the mining sector, that has been doing very well since about 2016, coming and bearing the brunt of the decline. So the mining sector halved during that 1 month period, and the other sectors roughly between 30 and 50% declines, as I've mentioned. And I think that was symptomatic of investors saying that we want the safety of cash. In a crisis, in uncertainty, we want the safety of cash. And we saw significant selling pressures coming through. And in particular in a global sphere, what we saw was that there was a flight to safety and safe havens. So the dollar clearly benefited, US Treasuries clearly benefited. And the casualties in that case was the South African Rand. Our Rand clearly blew out quite significantly. I think we touched levels of over 17 Rand to the dollar previously. And also anything related to emerging markets, which South Africa, unfortunately, or fortunately, being one of the larger emerging markets, also clearly significantly impacted by that. So that was sort of the crash. Then the market bottomed at about the 23rd of March, so almost exactly a year ago. And since then, we've seen this very stellar recovery. In particular, if I looked at the numbers yesterday, our market, exactly from the low till yesterday, was up about 70%. So clearly a significant recovery. And I was looking back at my Facebook posts about a year ago. And one of the things that I posted was to say that people shouldn't panic. They shouldn't crystallize these losses by selling their portfolios right now. And I think in hindsight, that was the correct sort of advice to give people, or counseling or guidance, in the sense that if you had sold at the market low around the 23rd of March in 2020, you would have crystallized that 35% decline in your portfolio, and you wouldn't have recouped the losses in the subsequent year. And I think if I look back at the portfolios today, all of our portfolios across the board are much higher now compared to where they were pre the initial panic selling that we saw in February, March last year. Now, and I think I'll pause there, but I think that has been basically the nutshell of what we saw in markets and market behavior.
Now, Abdulazeez, obviously, I mean, before the pandemic already, South Africa was not the wealthiest country on earth, and it had a failing economy, or maybe failing is a stronger word, but it had problems in its economy. The government has obviously gone into further debt now to stabilize the system and to look after its people, to sustain its people. How is, debt is something that all of us are scared of at this stage. And for a country, I mean, if we look at the numbers that was taken, 500 billion Rand, additional 200 billion Rand a year, and whatever, it's huge amounts of money. That obviously has to be repaid. How does that in itself impact on the economy going forward?
So significantly, I think, there's been a global precedent for a lot of the actions that our government took. So from the initial, we tried to have a very hard lockdown to try and kill off the virus. Unfortunately, that didn't work. But all of those lockdown measures was, effectively, done in other countries as well. So we were not alone. And I think there was some precedent elsewhere. And then similarly, the stimulus response that you referred to, we saw other countries also likewise, try to stimulate the economies. As one would appreciate, with the hard lockdown, economic activity just plummets. I think in that Q2 last year, our economic activity declined by over 70%. So that is significant, and but of a similar scale of what we saw elsewhere. So in response to that, we needed an economic revival plan to offset that as well. Now, clearly, as you rightly said, I mean, there is a cost. The cost is increased debt. And certainly from our analysis, a country's ability to respond to the economic crisis of the pandemic varies, and is mainly a function of a couple of things. First, it's a function of the health of the balance sheet of the country. So as you said, effectively your debt to GDP ratio going into the pandemic is also a function of the extreme or the severity of the lockdown measures implemented as well. So initially we saw places like Sweden, for example, not having any lockdown whatsoever. And the economic growth was obviously left unscathed almost for the initial period, certainly. But likewise, given the severity of our lockdown level 5 that came through, we needed an economic response that was commensurate to the decline in economic activity that we saw. So that initial 500 billion rand of sort of stimulus measures, etc., I think was disproportionate in relation to both the severity of the lockdown, but also given the little breathing room and maneuver, sort of areas of maneuver that we have as a country, that going into the pandemic, we were already in a recession. If you look back at Q4 2019, that quarter we saw a recession already in the country. So the Q1 of 2020 was already quite a vulnerable period. And then also our debt to GDP levels were well above 50% already. So, I mean, we were just downgraded already, and we were on watch. And during the pandemic, we saw the Moody's downgrade coming through as well. So I think, all of that conspired to leave us in quite a vulnerable state in terms of our government's ability to respond effectively to the crisis as well.
Okay, now, obviously, I mean, if one looks at that, I mean, if we compare what South Africa did to the rest of the world, it's basically in line with the rest of the world. I mean, everyone was suffering. I mean, if we look at the US, for example, I mean, the US was probably hit the hardest. But interestingly enough, last month we saw Minister Tito Mboweni deliver the budget speech. And one of the key moments in his speech was when he said that this is not an austerity budget. So
Yes.
he made it very clear. I think he made it very clear. South Africa is not looking down those lines. They are looking at the recovery plan. I think a plan probably would be the best word to use, that they place to assist the recovery of our country going forward. Am I correct in saying that?
Yes, so I want to touch on a couple of things that you've mentioned. Firstly, let's just take a step back and talk about the economic response. So one of the slides that we will share with the viewers is effectively looking at various countries' sort of stimulus measures as a percentage of their GDP. And Germany, by far, given Germany's strength in terms of their balance sheet, let's call it that, in the sense that they've had a very strong economy for the last number of years, and effectively we've seen the German response being about a 40% of their GDP in stimulus measures. Now, to put that into context, China, which was the epicenter and ground zero for this pandemic, only had about a 6% of GDP stimulus response. South Africa, in terms of our stimulus response, is similar in magnitude of around 6 to 7% as well. So that gives you a scale in terms of how the economic response has been country to country. Coming back to the budget and what the minister delivered, we certainly feared that we would have seen a significant increase in taxes and a significant curtailment and cutback in expenditure, which is typically the hallmarks of what you call an austerity budget. Austerity in terms of tightening belts by curbing expenditure, and then also trying to raise additional tax revenues. I think the silver lining of this entire pandemic has been, firstly, the initial weakness in the currency, and then also the significant stimulus response that we saw from places like China in terms of infrastructure spending, and also the rest of Europe, as I've mentioned. Now, that has meant that certainly our mining sector has benefited significantly from that. To give you a sense, something like the iron ore price went from about $60 per ton, it went to $170 per ton. Something like the palladium price, which is part of the platinum group metals, more than doubled during the last year. The rhodium price went up something like 10 times in the last year as well. So certainly our mining sector benefited significantly from the initial pandemic, but also from the stimulus measures that was announced. And as a result, a company like Anglo American Platinum has become one of the largest taxpayers in South Africa, because their profits have basically increased by about 25 times over the last year. And that has certainly given government a significant tax windfall in terms of, they didn't plan for these additional tax revenues. It basically fell in their lap because effectively weaker currency, higher commodity prices, lower costs. I mean, the oil price obviously was quite low initially, and that meant that a lot of these companies saw the input costs actually declining. And that effectively resulted in significant increases in profits, especially in the mining sector. Now that has meant that the minister has been allowed to not have an austerity budget, because effectively the additional tax revenues has shored up what he lost out on booze and liquor bans and all of those other things by quite a significant degree as well.
Now, Abdulazeez, I mean, when we saw the onset in 2007, 2008, and 2009, the onset of the financial crisis, there were safe havens identified by investors, and one of those safe havens was gold, if I remember correctly. That obviously didn't apply here. We saw gold was under pressure this last year, or at least the last few months. But then again, we also saw platinum pick up quite significantly over the last while as well. Is there a change in thinking? And I know that cryptocurrency is also a factor here, but is there a different way of thinking at the moment as far as safe havens are concerned for investors?
Yeah. So there's a wider issue we need to discuss, which is really the responses and the consequences of stimulus. Because effectively, one of the charts that we have and that we'll share with our viewers is a chart which we look back over 100 years of just the increases in debt, in the US debt, in terms of a blue shaded area. And we've seen that there's been a significant increase in government debt in the US to unprecedented levels. I mean, it's basically over 100% debt to GDP in the US. It's the highest that it's been even compared to the Second World War period of 1945. Why is that significant? Because effectively, I wasn't around in 1945, but effectively we saw a war needed to be financed. So we saw these war bonds being issued, and that pushed the government of the US into significant debt position. But the post-war period, we saw significant reconstruction and development efforts where GDP accelerated significantly and they could pay back the debt quite significantly. So that was that phenomenon. What is different this time around is that we're not in a war situation. We don't have massive destruction of property. Obviously, there's been loss of life and economic hardship, but we haven't seen the scale of the destruction that we saw in World War II. So, time will tell whether we will see the same level of reconstruction that happened post the Second World War period that will allow us to grow out of the debt. But at the same time, we've got a phenomenon in the Western world, both in Europe and the US, which started in 2008 with the global financial crisis, where the US initially, they started what they call unconventional monetary policy, where the US Federal Reserve used their balance sheet to buy back debt. So as the government was issuing debt, the Reserve Bank was buying back the debt. So they were effectively sterilizing debt and effectively depressing the interest rate. So the blue line on this chart that we will share with our viewers effectively shows that at a time where debt levels are at record levels, interest rates are at record low levels. In fact, the US 10-year Treasury yield went below 1% for the first time in its history very recently. It has ticked up now to about 1.5% more recently, but it's gone below 1% at a time where debt is, at the highest level ever. And that is the twin effects of a government issuing debt and obviously raising the debt to GDP level. But at the same time, the Federal Reserve, or in our case, like our Reserve Bank, conspiring to lower interest rates by buying back the debt and effectively using their balance sheet. Now, a Federal Reserve has an unlimited balance sheet because they can just print paper, they can just print dollars, our Reserve Bank can just print rands. So they can they can buy back debt as much as they want. So the effect of that is that when they buy back the debt, they're adding liquidity into the economy. They're stimulating the economy over and above the debt that was issued by the government. This sounds very complex, but it's very simple in effect. Let's say you are a country and I'm a country, right? You now you want to buy a house. So you say, okay, here's a R1 million bond that I will issue to anybody that wants to buy this bond. So effectively, you're promising to pay back that bond in 10 years' time or 20 years' time. Now, I come along and say that, okay, I want to make sure that, so supply and demand rules. So effectively, with higher issuances, the rate should go up because there's an inverse relationship between your interest rate and your price of your bond, effectively. The more you issue bonds, the higher the interest rate, because the higher the investors need to be compensated for the additional risk of taking this paper. What then happens is that, let's say your son or your daughter then says that, I don't want my daddy to pay such a high interest rate. I'm going to help him by buying back the bond, right? So you then have somebody as part of your family, and effectively the Fed is family of the government. And effectively what they do is that they become a price maker in the sense that they buy those bonds. So you've got somebody in the family that said, you issue the paper, don't worry, I'll buy all of the bonds and we will keep the price low. That is effectively what's happening. Now, coming back to the effect on commodities and Bitcoin and cryptocurrencies in particular. So the initial response of gold was to actually go up. Gold touched close to $2,000, I think. It has retraced, it's now trading at around $1,700 per ounce. But the initial response is effectively what we would have expected. We saw that the gold price rally, and that is a function of a couple of things. First is safe haven status. Gold over hundreds of years has been shown to be uncorrelated to equity markets or negatively correlated in periods as well. And certainly, if you're talking about an Armageddon, for example, scenario, gold, is the ultimate sort of store of value in the sense that paper stock markets, they might go into oblivion, but you'll still have that tangible gold. So initially that favored the gold market. Where gold has fallen short is effectively in two key areas. Firstly, in terms of the perception of risk, and then also the opportunity cost that gold represents. And I'll just address those two things quickly. Firstly, in terms of the perception of risk, you need people to have that confidence and to think that gold will go higher, to have faith to buy more gold. And psychologically, for a lot of investors, 2000 was a barrier, was a top for gold. So because there was people and investors that liquidated their positions at that level, there was a bit of a loss of confidence in gold, which saw the gold price retrace. Now, that is typically, the indicator for that is what we call the ETF, the exchange traded funds. So it's institutional investors that would be buying and selling gold. So we saw a lot of buying ramping up to the $2,000 level, and then a lot of those positions being sold out at that higher level that put pressure on the gold price to come down. So that's the first point. The second point is the opportunity cost. Now, when interest rates are close to zero, gold is actually in a much stronger position because, as we know, gold is a metal, but it doesn't do anything. It doesn't pay an interest. It doesn't pay a dividend. You can't even make coffee from your gold. So it doesn't have alternative uses other than for jewelry or gold bars, right? So anything else that has what we call a yield, either dividend yield or that pays an interest rate, for example, would always be preferred in that environment because you can get actual cash flow from these competing assets as well. In an environment where interest rates are close to zero, investors, people that are pensioners, for example, are getting virtually nothing on the cash in the bank. They might as well hold gold because at least the gold price was going up. Whereas your cash in the bank doesn't go up and you get zero. However, what changed is as rates start going up, the relative attractiveness of gold decreases. Because in a rising interest rate environment, people will say, hang on, if I put my money in the bank, I will actually be starting to get something again, whereas gold gives me nothing. So the gold market limitation is twofold. Firstly, it is only precious and have that perception of preciousness. As I say, it's in the eye of the beholder. So with alternative competing assets, we've seen that has certainly lost its luster. The second point, as I've said, is that gold doesn't pay any income or cash or dividends. So competing assets that are paying something like that obviously becomes more attractive as well. The last component, which is where it's pertinent to something like platinum, is that gold doesn't have significant alternative uses. This is maybe not a fair comment, but on the Cape Flats, we know that gold teeth is obviously quite a big thing. But outside of the dentist environment, the dentist industry, and the jewelry industry, there isn't a wide sort of application of gold in terms of alternative uses. With platinum, palladium, there's definite real-world applications in terms of autocatalysis, catalytic converters, etc. And that makes platinum very different to gold. Ironically, the platinum price is still below the gold price as we stand today, but we think that might be changing in the not too distant future. So I think gold is quite unique in that perspective. Platinum and other commodities like iron ore, copper, because of their industrial uses and because of their real-world applications, there is fundamental demand for those metals in those industries, which makes it different to gold. The last component is cryptocurrencies, and this is where it gets very interesting. I will confess I'm not an expert on this market, but your typical and if you are a CFA charter holder or an accountant or anybody that has been trained in traditional finance, you would have been taught that any asset is represented by the cash flows or the benefits that will flow from it. And certainly when we invest in companies, we're looking at companies that have cash flows that can pay dividends. And similarly, we would rather prefer investing in a mining company than a mining commodity, because the mining companies will obviously have profits and pay dividends. Bitcoin is unique in the sense that Bitcoin was initially started as a means of exchange. It was a cryptocurrency that recognized the failings of the conventional monetary system, which was around the fact that the biggest weakness of the current monetary system is the ability of a central bank to just issue paper, to just print money. And that inflationary and debasement effect of your currency, again, supply and demand fundamentals say that if you print more currency, the value of that currency should come down. And certainly the US dollar, you can certainly see if you look at it on a purchasing power parity basis, the value of the dollar has declined over the years because of these, issuance of additional money supply. So cryptocurrency certainly was initially, I think, formulated and brought to the market to counteract that, and also to recognize that the fiat system of money has certain limitations. Where it gets interesting is the fact that, I think you're hard pressed to find anybody that is buying Bitcoin to trade. Most people are buying Bitcoin and cryptocurrency as an investment. And they're looking at it and saying that the price will go higher, so I'm buying it, buy to hold. The original idea with Bitcoin in particular was to have something like 21 million Bitcoins around. And mathematically, the rationale was that clearly each Bitcoin, there's an algorithm, there's a series of equations that need to be effectively solved to create your Bitcoins, which requires more processing power. You've got these miners that do this Bitcoin mining. So progressively, it becomes more difficult to have new issuance of Bitcoin, and there is a limit in terms of how much you can do that. Conversely, yeah. I'll pause.
Sorry, continue, Abdulazeez.
So conversely, on the demand side, if everybody's buying Bitcoin and nobody's trading it, you have this natural imbalance in terms of saying there are actually more buyers than miners, because effectively mining is declining because of the complexity and the intensity of the electricity usage, etc., of mining Bitcoin. But similarly, there is greater demand because the price is going up. Everybody wants to get Bitcoin because the price is going up. That confidence that is so lacking in gold at the moment has actually gone into cryptocurrency. And we've seen, from the likes of Tesla, institutional investors are now looking at the market. So naturally, because you've got more people attracted to this cryptocurrency market with limited supply and complexity in terms of creating more supply, that will push the price up. What is the end game? I'm not sure where the cryptocurrency actually ends up. What I do know is that, and my personal view on it, and again I must stress this is my personal view, is that there has to be a correction at some level, because Bitcoin needs to represent two things. It needs to represent the actual purchasing power of the asset, or it needs to represent the economic benefits in terms of either cash flows or something that you can tangibly get from Bitcoin. At this stage, I mean, Bitcoin is now a number of years old. At this stage, we are still trying to determine those equilibrium levels. So I'd be hard pressed to say that a fair level of Bitcoin is 20,000 or 50,000 or even 5,000 in terms of the dollar price for it at the moment.
Now, Abdulazeez, also looking at, Bitcoin is obviously something that's internationally available, and we've seen massive investments from a fellow South African, Elon Musk, investing huge quantities of money into Bitcoin. But looking at that international market, I mean, we've seen a lot happen in the US over the last while. We've also seen a lot happen in Europe over the last while.
Yeah.
And I'm speaking over the last 12 months. And, you know, when things change, that affects markets. But if the way it's affected markets, in my opinion, in my limited experience, it is not like normal times. I mean, for example, if we look at the US economy related to the elections of 2020, with the presidency, when the new president came in, we didn't see a massive change in the market, either positive or negative. Um, is that related to the current situation of the COVID-19 pandemic crisis, or are there other factors at play at the moment that's causing lull in effective use on?
I think you're referring to the US market in particular, or
Yes, specifically the US markets.
yeah. So the US market is quite interesting in that you've got a very sophisticated and very forward and almost progressive capital market system, both in terms of its stock market and also in terms of the Federal Reserve. And then certainly for the last 5 years, we think we had quite a I need to be kind here, ineffective political landscape in the US. So you know, it's this huge dichotomy between, as I always say, you know, between the White House and then Wall Street. And certainly, I think that US investors, they've benefited significantly over the last 5 years from, you know, if you look at the previous administration, they brought in the Jobs and Tax, the Jobs Act and the Tax Cut Act. So there's been a significant transfer of wealth from the US government effectively to especially the higher earning taxpayers. And ultimately that fed its way into corporate profits in the US. And then secondly, what we have seen is that, as we've just discussed at the beginning of our show, you know, the significant stimulatory environment of record low interest rates coupled with high debt to issuances in the US as well. So that has conspired to actually meant that, you know, we've seen successive market highs in the US, notwithstanding the fatalities, notwithstanding the ICUs unable to cope with COVID patients. And that is because of this, you know, the economic impact has almost been isolated and divorced from the human and medical impact of the pandemic. Now, clearly, as you've said, you know, some of it is due to ineffective policy. You know, simple things like mask wearing, sanitizing, not having large crowds. Initially, there was no enforcement of any of those. And we saw daily cases obviously spike significantly in the US. I think the new administration only came in January, but already we're starting to see, you know, leveling off in terms of daily cases and all of those good measures. Also, we are starting to see a much faster rollout of vaccines than we saw previously, and certainly in South Africa. So that is clearly giving markets, you know, a bit of a confidence booster in an environment where I think corporate profits and also the rating on those corporate profits has certainly gone to very high levels. One of the charts that we have in the slideshow shows just the level of US markets over a 100-year period. And effectively, through various market cycles, again, this is the highest level that we've seen in the US market. And the slide after that shows you what we call the PE rating, the PE ratio of the US, the S&P 500, for example. And again, that is at a very high level. Now, the US, similar to most developed markets, went into a recession. They had 2 quarters of recession in 2020. But by all accounts, they have emerged out of that recession. So that gray bar that we see on the slide effectively represent periods of recession. Now, the US is at quite an interesting inflection point in our view. Typically, after coming out of recession, we see a compression in that PE ratio, the black line, actually starting to go down. Now, that is a function of 2 things. Either it can be a good thing or a bad thing. The PE can either go down because earnings grow. So if you think of a PE, it's basically your price divided by the earnings for all of the companies that make up the S&P 500. If earnings go up, the PE ratio goes down. But if price goes down and earnings stay the same, the PE ratio also goes down. So you can have a positive outcome in terms of PE ratios coming down because of stronger earnings, or you can have a negative outcome in terms of prices coming down, forcing the PE ratio lower as well. I think from our vantage point, by sector, you'll see different outcomes. Certainly for the tech sector that benefited from the work from home environment, that were benefited from massive sales of laptops and PCs, etc., we should see a leveling off of that level of demand. So tech earnings should come under pressure somewhat. On the contrary, cyclical companies, materials, the mining companies, they should still benefit from higher commodity prices, etc. So there should be a medium where tech companies' P's come down because the price is coming down, not necessarily earnings go up. But conversely, your mining companies, your materials companies, you could see a significant increase in earnings and prices just flatlining, and again, those P ratios coming down as well. So to answer the question, it's really been a function of those two things, which, yeah, I think the next couple of months will be interesting to see how we actually see the unfolding and the unwinding of some of those behaviors that we saw over the last 12 months as well.
Now, speaking about the next 12 months, Abdulazeez, I mean, I think everyone's sitting on the edge of their seat at the moment, thinking about the future, especially in the South African markets context. I mean, we sit as expatriates living abroad. We interact with many other South African expatriates, and on our channel, we get a tremendous amount of interaction as well. And I think the main question now is there was some fear. There was some good news and some fear as far as the currency is concerned, the South African rand. We saw the rand weaken about a month ago, and then it's picked up again and strengthened once again. The fear was obviously we don't know what's going on in South Africa, and many expatriates living abroad and working abroad, and South Africans living in South Africa, obviously, we invest in those markets, in the South African market. And the currency is also a direct impact on everything we do from this side. What's your take on what we can expect over the next 12 months at least? Or at least, let's make it simpler. We're in the first quarter of the year. We have quarters left. What can we expect out of the next 3 quarters of 2021 going forward? And I know that the vaccine is present in South Africa at the moment. It is being rolled out, and maybe just to touch on the impact of that possibly going forward in 2021.
Okay, that's the 40 trillion rand question, and that's really the market capitalization of the JSE. So unfortunately, I don't have a crystal ball, but I can share my insights in terms of what are the drivers potentially of both our market and the currency as well, and how we see those interacting. Let's start with the bad news, and one of the slides that we share is effectively looking at just the extent of load shedding. And notwithstanding that we were in lockdown for most of 2020, 2020 was also an unprecedented year in terms of just the frequency and extent of load shedding that we had in South Africa as well. So it just shows that even in a weak economy, our power crisis is so dire that we don't have sufficient, access to traditional coal-fired power to keep the lights on. Now, we think that will always be almost the Achilles heel around a significant recovery in the South African economy. Because every time there's a significant spurt of economic growth, we've got load shedding because it's putting too much demand on the national grid. So certainly for the foreseeable future, and unfortunately that will be for the next couple of months, we should still see potential load shedding in an economic recovery scenario. Alternatively, the economic sort of output needs to be commensurate with the level of power that we have access to. And that will create a national inhibitor in terms of our economic recovery. So that certainly, I think, will put our economy under pressure and potentially is a negative headwind for the currency as well. So we could see a weakness in the currency as a result of that. I think the other disappointing thing has been that our vaccine rollout has been quite slow as well. I think the initial target was to vaccinate 1.2 million healthcare workers by the end of this month. I think to date we're still below 200,000, and there's like less than a week left for the remainder of this month. So I think clearly the rollout has been disappointingly slow, and unfortunately we've seen those same challenges in even sophisticated and advanced countries like Europe, for example. So I think those challenges are not unique, but certainly in our case, they are exacerbated by poor planning and poor administration of the vaccine rollout as well. And I think that potentially brings us into the scope of something that is uppermost in our minds, certainly, and that is the very real prospect of a third wave. I mean, currently we're seeing similar characteristics in places like Germany, Italy, for example, going through what might be considered a third wave of infections. And that's because clearly they haven't got the rate of infection under control. But secondly, also, we haven't seen mass rollout of vaccines that can counteract and combat the likelihood of a third wave. Now, as you know, we're going into our South African winter, and vaccines are still not, at a level we can say that. I mean, the government's target is to vaccinate 67% of the population to ensure herd immunity. We haven't even done 1% of the population yet. So I think there's a very real prospect of a third wave that could potentially put, our fragile economic recovery under significant pressure again. I'll pause there.
Sorry, Abdulazeez, I think our connection's been bad there. We didn't quite follow what you had to say.
Yeah, so I was saying that there's a very real prospect of a third wave in South Africa, given that we're going into winter, and the fact that our vaccine rollout hasn't been at the scale that we would have wanted to see. I mean, I think less than 1% of the population has received a vaccine, and government's target is to vaccinate at least 67% of the population to achieve that herd immunity. So I think that will further put the economic rebound and recovery on the back foot, and also could put pressure on the currency as well for the subsequent months lying ahead. Now, I think just to roll that back, I mean, there is obviously some good news as well. I think our economic recovery is probably a lot higher than we anticipated. We know that 2020 we saw about a 7% contraction in the economy. We would have expected about a 2.5% sort of growth rate for 2021. If you look at the Reserve Bank numbers, they're talking about 3.5% growth rate for 2021. But over and above that, as we discussed previously, the mining profits that we've seen, the additional taxes, and the fact that government hasn't raised taxes, for this current financial year or fiscal year, means that there is a bit of breathing room for the average South African consumer, which could, put us on a stronger footing compared to where we would have been. And given the fact that the currency is where it is, imported goods are not as expensive as they might have been if the rand was at, say, 19 rand to the dollar. And even with this increase that we've seen in oil prices are coming back down again. So we could see further relief in terms of, pump prices, in later months, and that could have a spillover effect in terms of inflation for the subsequent months as well.
Abdulazeez, some final words from you as far as our communities are concerned as far as investing. Now, I know that Kagiso has also had a few achievements during the pandemic crisis, not a few, many. And that clearly shows that you're running a tight ship, that you guys know exactly what you're doing. I mean, to weather the storm for the last 12 months, it surely took nerves of steel and a very clear head to captain that ship through on behalf of the money through this time. In your opinion, opportunities going forward for South Africans looking to invest?
Yeah. So yeah, I think there's a couple of things I want to address. Firstly, I think, in my 23 years in financial markets and, in equity markets in particular, each crisis is different, but human behavior always remains the same. And, with experience and with cool heads, you can actually make significant investment returns for your clients. And that's certainly, we think that March 2020 represented quite a unique, once in a lifetime almost buying opportunity. What we did is we bought quite a few of the miners. We bought a company like Anglo Platinum, for example. It fell to about 700 Rand a share in March 2020. Today, that share price is over 2,000 Rand a share. So it's almost up threefold in the space of a year. Similarly, a lot of the mining companies have benefited from the rebound that we've seen. To the extent that our funds have done between 50 and 60% returns since the March low of last year over the last 12 months. And we far exceeded, our peers and the various benchmarks in terms of our performance. And as you rightly said, I mean, notwithstanding, the pandemic, we've won quite a few awards again, Morningstar Awards, Rating Bull Awards, and it just shows, I think, the benefit of having an active, bottom-up, valuation-orientated investment approach. Because certainly most sort of alternative approaches, which was either to buy and hold or to panic sell, would have been disastrous for investors during the last 12 months. And then on top of that, I think, where we are in terms of the second part of your question, in terms of opportunities, we are certainly quite excited. I think there's been companies that have lagged in terms of the recovery. Some of our and quality companies like MTN, for example, are still at a lower level compared to where it was pre the pandemic. Similarly, certain mid-cap companies, we've got a company like Lipstar, for example, that's in the food producer space in South Africa, which we think is a fantastic opportunity at the moment. Also, companies like Omnia, which unfortunately was a casualty of poor timing. They had to do a rights issue amidst the pandemic because they had a poorly timed acquisition. So that company went from 200 Rand a share to 26 Rand a share where they priced the rights issue. We participated in that rights issue, and today the share price it's almost doubled to about 50 Rand a share. So I think there's and that share certainly still has legs in our view. But what really excites me is the offshore opportunities that we're seeing. We've done a lot of work in terms of the hydrogen economy, and this is potentially the silver lining for both South Africa as a country and also for both our mining stocks and also the global opportunities that we see. Certainly, the platinum industry is at the forefront of the developments around the hydrogen economy. Last year in June, the EU committed about $130 billion to a hydrogen sort of revival plan. Similarly, we've seen the US having similar pronouncements as well. And certainly, from a hydrogen input point of view, our platinum and palladium, mainly platinum sectors, are uniquely positioned to benefit from the rollout of hydrogen fuel cells, for example. And similarly, we find on a global basis quite a few opportunities in that sector that are currently in our global portfolios as well. So I think as this economic transition happened and the world transitioned to a hydrogen, a zero carbon emitting sort of fuel source, it does have potential silver linings for both South Africa as a country, but also for our mining industry and for our investors in our portfolios as well.
So I'm very proud to say that I'm associated with your company. Not only associated, but I once worked for you as well. So when I see this in the news, I'm very proud to know that at least I had some association in the past and still currently have an association with Kagiso. Abdulazeez, you've given us a lot of information. And our following and our viewers are of an international audience and who are always looking for opportunities in South Africa. I think the information that you've imparted today is pertinent to those people making up their mind on where and how best to invest in South Africa. From Kagiso management side, is there any message to clients, prospective clients, and future clients that you have?
Yeah, I think there are three separate messages. Firstly, to existing clients, thank you for the support. And I had to field many. I mean, part of why I'm so great is because of all of the calls I had to field in March last year. of panicky investors. And I think fortunately many of them heeded our calls not to divest and not to liquidate their investments, to the extent that we've actually had a very good year in terms of flows as well. I think going into the pandemic, we were sitting at about 2.5 billion of Sharia funds under management. Today, we're sitting at about 3.6 billion of Sharia funds under management. So it's grown by about 1 billion in the last year. And that's because many of our investors didn't panic. And on the contrary, so many of them have actually contributed more and they've actually put in money at the market low. So I want to congratulate them and obviously encourage them to stay invested. I think for prospective investors, we now have a almost 12-year track record in managing Islamic funds, and we were the last kid on the block when we started, or the new kid on the block. But over the last almost 12 years, I can say the numbers are there. We are the best performing Sharia fund, both in terms of equities, in terms of the balanced funds that we manage. Our income fund has done exceptionally well over the last year as well. We know that many people were worried about economic losses and declines in investment values. But our income fund, the Sharia compliant income fund, has done about 17% in the last year. And that's amidst the pandemic and the economic crisis that we've seen. So certainly for prospective investors, we can cater for very low risk investors. We can cater for people that have moderate risk appetite. And even those that have a bit more risk appetite for global funds. We've got a UCITS fund based in Ireland, for example. For South African investors, a Rand feeder fund is available. So we certainly cater for the full risk spectrum and for any risk appetite amongst our viewers and listeners as well.
So Abdulazeez, thank you very much for your time, and I hope next time we chat to you, the hair would have gone a bit darker, not whiter, going forward. But we wish you all the best and the best of luck for that. And again, thank you very much to Kagiso Asset Management for the support that you've shown the Diplomat in the weekly roundup for the last while. And we hope that this lasts many years into the future. Thank you very much for your time and best wishes to everyone at Kagiso.
Thank you, and all the best to our viewers as well. Thank you.
That was Abdulazeez Davids of Kagiso Asset Management, and we wish to thank Kagiso Asset Management also for the support that they've given both to the weekly roundup and the SA Diplomat Abroad. I hope that you as a community have benefited from what was imparted information-wise by Abdulazeez today. Both South Africans living and working abroad and South Africans with your feet firmly planted in South Africa. The information that was imparted is very beneficial to all of us, whether we're looking to invest or whether we're looking to just generally save in South Africa. Don't forget to like this video, subscribe to the channel and pound that notification bell. Also, if you want us to interview anyone on any topic, please don't hesitate to make contact with us via our YouTube channel, our Instagram, Facebook, Twitter, or even LinkedIn. Don't forget to visit our website also, www.sa-diplomat.com, for further information. Until next time, goodbye.